Over the last 5 years or so, cryptocurrency has been a major topic of discussion around the entire world. After the huge spike in Bitcoin's value to over 50,000 US dollars in 2021, everyone wants a slice of that crypto pie. But most people don't know where to start. We're here to show you how you can use cryptocurrency to make yourself a ton of money. First up, we have mining. Most cryptocurrencies rely on computer users to volunteer their machines for participation in the proof of work or POW system. That POW system is essentially how transactions are validated and entries are added to the blockchain ledger. Without a system of validation and amendment such as this, cryptocurrency would just not be possible as a decentralized form of currency. In return for volunteering your machine, the POW system offers you the chance to earn crypto, but that's only if your machine is the first to complete a validation task. Over time, the value of crypto that you might earn from completing a task has depreciated, and this method has become a lot less lucrative. Regardless, many individuals have set up crypto farms that consist of hundreds of machines, all working at once to validate transactions, maximizing their chances of earning currency. That means that the chances of you earning crypto through mining with just a single machine are extremely low today. And for this method to be viable, you'd need a large initial investment to procure the necessary hardware. There are, of course, other systems of validation that are alternatives to POW. One such alternative provides another great way to earn crypto. You can maintain your own masternode, which is essentially a cryptocurrency wallet that holds a copy of the entire network within itself. These are primarily used in a sister system to POW, known as the Proof of Stake System or POS. The Dash cryptocurrency first implemented this, and the benefit of maintaining a masternode is that a large chunk of the block rewards, which are in crypto, go to the owner of the node when a block in the chain is verified. Hence, it's quite lucrative, though maintaining a system that can hold a copy of the entire network may be quite expensive. Next is investing. You may be familiar with this strategy as it applies to any form of currency, commodity, or stock. The basic idea is that you purchase crypto assets and hold them for some period of time, allowing their market value to fluctuate. In the short term, cryptocurrencies tend to fluctuate wildly, but it's been shown that over the past decade, the trend has generally been upwards in value. It's therefore a very good decision to buy at a point where the currency is at a fairly low point and hold the assets for a long period of time, say 5 years or so, when the value has increased by a large amount. At that point, you can sell the crypto in exchange for tangible traditional currencies, or invest in other commodities or products. However, it must be said that short-term investments, those that last under a year, can also be quite favorable if the initial investment is large and one knows exactly how much they stand to lose or gain at any given moment within that time frame. Then we have trading. This strategy requires a lot of expertise and analytical skill. While investing in crypto generally involves buying and holding assets for long periods of time, trading is essentially the exploitation of the volatile nature of crypto in the short term. Most traders tend to work daily, analyzing market trends to make educated assumptions about asset price fluctuations on a regular basis, appropriately taking a long or short position on any assets according to whether they are bullish or bearish, and exchanging those currencies. Day trading doesn't offer large returns on investments initially, but if one can appropriately analyze the charts consistently, the meager returns may eventually add up to a very large sum. If you're going to get into day trading, you're going to have to build up an understanding of test, support, and resistance levels, among other things. Resistance levels are essentially the values at which a major shift occurs in the trends of asset charts, with a sudden shift to a downward trend from a stable upward trend. Support levels are the opposite, describing a sudden change from a downward trend to a favorable upward trend. Understanding when these occur and why are major components of asset analyses. Another way is lending and borrowing. If you have already invested in cryptocurrency, you don't need to let it sit and wait for it to appreciate in value. There's also another method you can make use of known as lending. It works as any loans do, whether it be with large banks or small-scale loan firms. It works like this. Lenders offer up some amount of money, either in traditional currency or cryptocurrency, and borrowers pledge their current holdings of cryptocurrency as collateral in case they sustain losses and are unable to pay it back. A contract is mutually signed between these two parties, with the borrower accepting some agreed-upon interest rate. The difference here is that these two parties are typically individuals operating on a particular platform rather than large-scale organizations. If you don't know where you can use this strategy, don't worry. There are a number of platforms that support lending and borrowing, such as BlockFi, Oasis, and Nexo. And then there is airdrops. This is quite a risky method to rely on, but it is 100% free free if you don't count your money and time spent on seeing it through. We say see it through because, well, it's really going to test your patience and resolve. Airdrops are essentially free giveaways of cryptocurrency, and you can normally find them being announced on forums and cryptocurrency websites. They are usually attempts by startups and large companies alike to boost support for their currency. Unfortunately, more often than not, these are usually scams, trying to get you to eventually exchange valuable currency for crypto that has no real value in any meaning of the word. What's doubly unfortunate is that any crypto received through airdrops is also considered taxable income. But hey, free is free. Next on the list is staking. We've mentioned POS or proof of stake systems earlier, but we didn't really get into detail about them. These systems involve the use of staking wallets as nodes that actually support the cryptocurrency, rather than mining machines, instead of the POW systems that cryptocurrencies like Bitcoin use. Holders of cryptocurrencies that use POS systems can make use of a strategy known as staking. Staking is simple when you break it down. Essentially, it just involves holding crypto in your wallet for a long period of time, letting it generate interest. It sounds ridiculously simple, but it's a consequence of how these currencies work. Validator nodes are the foundation here and are used to verify new blocks of transactions to be added to the blockchain. The way you actually create a validator node is by staking and locking up some of your crypto holdings. If the validation is incorrect, you'll lose some of that staked crypto. But if you successfully validate a block, you receive more of that crypto in return for your trouble. The method of validation can differ between cryptocurrencies that are built on this system, but the idea of staking and being rewarded is common between them. Some platforms may also let you stake holdings without having to validate new blocks yourself. In these cases, you may be paid interest over the course of a year simply for holding the cryptocurrency in question, while other validator nodes do the work. When a block is validated, if you're a stakeholder in that particular validator node, you'll be rewarded with some of the earnings from that verification. And then we have NFTs. Our final topic in this video is going to deal with non-fungible tokens, or NFTs. They've been all over the news during the past 2 years, and they have a lot of potential to be money-making machines for a lot of people. But what exactly are they, and how do you use them to make money? NFTs are digital assets that can't be changed or manipulated, like images or audio recordings. They stem from the basic technology that allows blockchains to function and are therefore usually linked to certain cryptocurrencies. Think of them as acting as individual coins in a cryptocurrency, with their transactions being recorded on a blockchain. That record is what establishes an NFT as distinct and what gives it its value. The exact value of any particular NFT is driven by consumer interest, as with any real-world commodity. Since anything can be an NFT, it really comes down to the quality of the asset and how it's marketed. There are multiple ways you can go about making money off of them. The first is creation. Once you've made a good asset, you can market it well and potentially sell it or rent it out for consistent royalties or rent income, respectively. The other option is trading. You can trade NFTs like you would with cryptocurrency, buying NFTs when they're low in value and selling them when they appreciate. As with any real-world commodity, there's no limit to what you can do commercially with NFTs. That's a wrap for this video. Can you think of any other ways that cryptocurrency can be used to make money? Let us know in the comments below. Make sure to give this video a thumbs up and subscribe to our channel for more videos like this. See you in the next one.